Ever wondered how banks, billionaires, and even your travel plans are secretly connected through a $7.5 trillion daily money game? Welcome to the world of Forex, where currencies fight and smart traders win. And guess what? You don't need a Wall Street job to join the game. You just need to understand how it works, and that's exactly what we're about to uncover. Imagine you're planning a trip from the US to Europe. You'll need euros instead of US dollars. So, you go to a currency exchange counter, hand over $100, and get back 90 euros. Behind that simple act lies the world's largest and most liquid financial market, the foreign exchange market, or Forex. The Forex market is where currencies are bought and sold. It's massive, with over $7.5 trillion traded daily, and it runs 24 hours a day, 5 days a week. Whether you're a tourist, a multinational business, or a day trader, you're part of the Forex world in one way or another. But how does this market actually work? Let's dive deep into the mechanics of Forex. Chapter 1. The basics. What exactly is being traded? In the Forex market, you're not buying or selling physical goods. You're trading currency pairs. Each trade involves two currencies. One is bought, the other is sold. Example, if you believe the euro will rise in value against the US dollar, you might buy the euro USD pair. This means you're buying euros and selling dollars. Think of it like this. You go to a bakery and exchange $5 for a cake. In Forex, you exchange dollars for euros, or any other currency. Common pairs. Major pairs. EUR, USD, GBP, USD, USD, JPY. Minor pairs. EUR, GBP, AUD, CAD. Exotic pairs. USD, INR, USD, TRY. Each pair is quoted like this. EUR, USD equals 1.1000. This means 1 euro equals 1.10 US dollars. Chapter 2. How prices move. The role of supply and demand. Currency prices change due to supply and demand. If more people want a currency, its value rises. If fewer want it, the value falls. Real-world example. Suppose the US economy is booming. Investors want to put their money into US stocks. To do that, they need dollars. As they buy more USD, demand rises, and the dollar strengthens. On the other hand, if a country has political instability, investors may pull their money out, decreasing demand for that currency and weakening it. Chapter 3. Who are the players in the Forex market? 1. Central banks. They control interest rates and influence their currency's value. Example, if the Federal Reserve raises interest rates, the dollar often becomes stronger. 2. Commercial banks. They process Forex transactions for clients and do large trades for profit. 3. Multinational corporations. They use Forex to pay for goods or services in other countries. Example, Apple selling iPhones in Japan will convert yen to dollars. 4. Retail traders. That's people like you and me who trade for profit. Chapter 4. What moves currency prices? 1. Interest rates. Higher interest rates attract investors seeking better returns. 2. Economic indicators. Jobs reports, GDP growth, inflation rates, they all move currencies. 3. Political events. Elections, wars, and policies can shake or strengthen currencies. 4. Market sentiment. Sometimes it's not about facts but how people feel. Fear and greed drive markets just as much as numbers. Chapter 5. Understanding the Forex chart and bid, ask price. Forex prices are shown in bid, ask format. Bid, price at which you can sell. Ask, price at which you can buy. The difference is called the spread. Example, EUR USD equals 1,000 over 1.1003. Spread equals 0.0003, 3 pips. You buy at 1.1003 and sell at 1.1000. Pips. A pip equals the smallest price move in a pair. Usually 0.0001. If EUR USD moves from 1.1000 to 1.1010, that's a 10 pip move. Chapter 6. Leverage, the double-edged sword. Leverage means you can control a large position with a small amount of money. Example, with 100 to 1 leverage, you can trade $100,000 with just $1,000. Buyer good side, higher profits. Warning risk. You can lose money faster. Chapter 7. How a trade works, start to finish. Example. Let's say you believe the British pound will rise against the US dollar. You buy GBP, USD at 1.2500. You set a take profit at 1.2600, exit with profit. You set a stop loss at 1.2400, limit your loss. If price hits 1.2600, you profit. If it drops to 1.2400, you exit with a loss. This is risk management, one of the most critical parts of Forex. Chapter 8. Types of Forex traders. 1. Scalpers. They open and close trades in seconds or minutes. Goal. Small profits many times. 2. Day traders. Hold trades for a few hours. Goal. Profit from intraday moves. 3. Swing traders. Hold positions for days or weeks. 4. Position traders. Long-term investors. They look at interest rates and macroeconomic trends. Chapter 9. Fundamental versus technical analysis. Technical analysis uses charts, indicators, and pattern. Support and resistance, moving averages, RSI, MACD, Bollinger Bands. Fundamental analysis uses news, interest rates, and economic data.